What is equity crowdfunding? That is the topic of today's video. I'm going to break down the difference between traditional crowdfunding and equity crowdfunding. I'm going to explain a little bit about how it works. I'm also going to overview some of the platforms that are available to either raise money on if you're the entrepreneur or to invest in if you're the investor. I'm also going to share a little bit about the numbers of how that works and the future of where equity crowdfunding is going. Now, I'm going to be sharing this perspective from the entrepreneur as well as the investor. I personally have raised twice through equity crowdfunding for my company over $500,000. I did a video on that topic, so if you haven't already checked it out and you're interested in raising money for your company, make sure you check it out, linked in the description below. I'm also an investor in a lot of companies via equity crowdfunding. If you haven't already checked out my video, How to Invest in Startups, a beginner's guide to angel investing, make sure you check out that video. It's actually one of my most popular videos. Check it out, linked in the description below. Now, you're probably already familiar with crowdfunding. Crowdfunding is basically funding a project or a business with a small amount of money from a large number of people. You guys have probably seen the platforms like Kickstarter, LaunchGood, Indiegogo. These have been around for a little over a decade, and basically you can pre-sell a product, so you can be pre-product and you're about to launch and you're collecting funds and you can pre-buy the product for $10, $50, $100, whatever the product may be. Maybe the company is pre-revenue, you can pre-sell. There's a lot of different ways to go about it, but oftentimes these are very early stage businesses or organizations. They may be mission driven, they may be profit oriented, but you get a very big variety and diversity of companies that are trying to raise funds on one of these platforms. The most notable is probably Oculus VR. Now, if you're not familiar, Oculus launched in 2014 on Kickstarter, I believe, and they were sold to Facebook for $2 billion. So, crowdfunding has been around and we've seen some wild success like that, but equity crowdfunding is relatively new compared to traditional crowdfunding, and it is essentially an investment round with the crowd. So you have traditional investing, private investing in these private companies, but now we're opening it up to pretty much anyone. And this is a pretty big shift that's happened here in the last 4 or 5 years or so. And basically this expands the traditional friends and family round. So we've all heard this story. Someone has an idea for a company, they just started it, they have a rich uncle, and the rich uncle gives them $500,000 or $100,000 or $50,000 to start the business. If someone's from a well-off background, it's a lot easier for them to access that capital because their immediate friends and family have the funds. And so traditionally, that is how you could raise money if you were in that position. And with equity crowdfunding, it's basically democratized the fundraising process because now with a website and a landing page, you can pretty much raise money from literally anyone. So you get the benefit of a massive crowd and people can invest smaller chunks of money. And basically you can publicly ask for funds from both accredited and non-accredited investors. So if you have a legally set up equity crowdfunding campaign, you can actually publicly solicit funds from anyone. And in a traditional sense, you actually can't do that. That is illegal. You cannot publicly solicit funds from professional investors, let alone anyone. So I mentioned the word accredited versus non-accredited investors. And so we're going to jump here and we're going to talk about what an accredited investor is and why it matters. So by the SEC, the Security and Exchange Commission, this is the government in the United States, they basically say an accredited investor is someone who makes over $200,000 per year or $300,000 for the family, man or wife, and then has over $1 million in assets excluding the primary residence. And so this is basically a very affluent person, and 90% of the population does not fall into this category. So up until the Jobs Act of 2012 and Title III in 2016, it was actually illegal for anyone to invest in a private company if they didn't fit this criteria. And so now with Title III, as of 2016, literally anyone can set up one of these pages if they're approved. They can file a Form C with the SEC, and now you can publicly solicit funds for your business from both accredited and non-accredited investors. In fact, my company in 2017 was one of the first companies to actually do this, publicly launched on WeFunder. Again, I mentioned I already did a video where I raised over $500,000 through equity crowdfunding on the platform WeFunder. So if you're an entrepreneur and you're looking to raise capital, I highly recommend checking out that video. Let's go back to talking about equity crowdfunding. So on these platforms, typically you can raise anywhere from $50,000 up to $1.07 million. Now that's in regulation crowdfunding. You can also form a Reg D. So if you're going to end up raising more than $1 million and you already have a campaign running, you can actually push beyond that, but you have to sort of open another offering separate from regulation CF. And I mentioned regulation CF, CF being short for crowdfunding. That is the legal name. Now there's three big platforms. There's actually a couple dozen of them. Three of the biggest, I already mentioned WeFunder that our company raised twice on. There's Start Engine and there's Republic. Now I mentioned these three platforms and I'll link their information down below. If you guys are interested, check them out. There's tons of companies that are raising, typically business to consumer, but there's also B2B type companies. And the way it works, you might be thinking like, how does this actually work? So if you're gonna raise funds, you have to actually file a Form C with the SEC. So there's a little bit of legal and accounting logistics, but it's really been simplified over the last few years. It takes about 3 to 4 weeks to have that legal stuff set up. And then if you're gonna raise, normally these campaigns are open from anywhere from a couple of weeks, about a month, to 3 months. And that's when, if you're the investor, you have the opportunity to invest in these companies. Now, the campaigns can be open for much longer and they can be open rolling. So I did mention you can raise up to $1 million and that has to be done within a 12-month period. So sometimes companies will actually open up a round, raise some capital in a tranche, they'll close the round, and then 4 or 6 months later, they've accomplished certain milestones, and then they raise money again. They open up the campaign for a short period of time. In our first campaign, we were open for about 4 months, and then in our second campaign, we raised close to $500,000 in only 3 weeks. So it can be done in a number of different ways. You might be thinking, why would you want to do this if you're the entrepreneur? And then I'll talk about why you want to invest if you're the investor. So why if you're the entrepreneur? 3 reasons. Number 1, you get access to pretty much anyone. The market can invest, and these people can be evangelists and ambassadors for your business. So if you're B2C especially, you can basically have 1,000 people who already use your product now are investors, and they're going to promote your product or your offering or your service much more than they would because now they're an investor. They own part of the company. Additionally, you can raise funds faster. I mean, think about it. If you just set up a page versus having lots of meetings, you can't meet with 1,000 people, but you can raise from 1,000 people in 2 weeks. And you can't really do that in a more traditional setting. And thirdly, again, you get access to the marketplace, the platform of investors who are already looking for companies or they've already invested in a specific startup, and then yours pops up and maybe they're interested in it. So by the numbers, and these are WeFunder numbers, so I want to clarify, Johnny Price, if you're listening, Director of Fundraising, I listened to an interview and this is where I got these numbers from. Basically, by WeFunder's numbers, 90% of the campaigns are raising in equity round. What that means is a third of them are either doing a price round, so a $5 million valuation is what you're buying into, or it's a convertible note. So basically you're investing, it's a loan, but it converts into equity and future financing. And then a third of that 90% are setting up a safe, simple agreement for future equity, which basically means that you're investing for the right to have equity in the future when the company raises additional financing. Both of my company's rounds were done via a safe. If you guys are interested, let me know in the comments. I can answer questions about that. And then the other 10% are doing more traditional like interest or revenue share, kind of what a bank does. So you set out a loan and then you have to pay it back, or you get revenue share from the company's success in the future. Now you might be thinking, if you're the investor, why would you want to invest in something like this? Basically, you're investing at the earliest stage of the business. You're helping the entrepreneur bring their idea to life. So if you go and invest in a company like Apple or Facebook, these companies are already very mature. They're in the public market for a reason because they've already achieved significant scale, and now your funds are basically just fueling the growth of an existing machine. From both the entrepreneurial side of helping someone take their idea and bring it to life, that really feels great to be able to help the entrepreneur, but also from a financial perspective, you're able to see the highest return on investment because you're investing at the lowest valuation. If you were to invest in, say, an Oculus company and then it exits for $2 billion or it goes public, you're going to 1,000 times or 10,000 times or 100,000 times your money. Not to say that happens to everyone, but you have the opportunity to do that. So if you're interested in learning how to invest in startups, make sure to check out that video linked in the description below. Another number here that's really interesting is the scale of what's happening in the marketplace. This is growing very fast. WeFunder is doing about $10 million in funds raised through the companies on the platform every single month now. I believe a year ago, it was like 1 or 2 million. So in a year, just one of these platforms is seeing 5 times as much investment volume going through the platform into startup companies. If you can project out in the year 2021, 2022, 2023, these platforms will be much larger by the scale, the number of companies, the quality of companies that are raising, as well as the amount that is being raised and invested into these companies. So when we look at the future, where is this going? Number one, COVID has accelerated this because it's very difficult to fly out to a meeting with an investor. If you want to have a meeting at a coffee shop, it's just not going to happen. And rather than setting up Zoom call or video call after video call, you set up an online equity crowdfunding campaign, you raise money from 500 or 1,000 different investors in one shot in a month, and it just saves time. So a lot of companies have gone to equity crowdfunding because it's just easier and faster to raise funds, especially considering a lot of VC funds have really tightened their belts and they become, quite frankly, more stingy. So the public investor, the retail investor like yourself watching this video or me, we have access now to these companies that really weren't thinking about raising before, but now they've been pushed into equity crowdfunding and we can benefit out of that as the investor or even as the entrepreneur. And I did mention having meetings versus online. It just doesn't make sense to go and have meetings individually when you can do it at scale. This is the millennial where we are using technology to scale things. So it makes a lot of sense, and we're democratizing funding. So that's why I'm really interested in this. That's why I decided to, with my own company and with my own money, to go this route, just because you have the opportunity to really see that potential high return on investment on the finance side, but also to help other entrepreneurs, and other people have helped us bring our vision to life at our company. And finally, the SEC is considering raising the limit from $1 million to $5 million. And if that happens, discussed right now, I believe, that would be huge, because now a lot more companies are going to consider this route of financing because you can raise up to $5 million. So the quality of the companies, the stage of the companies is going to be a lot more mature, not close to public market, but more mature at the earlier stages, the seed, Series A round. And traditionally now, it's more like pre-seed, seed rounds. So we're going to see more Series A rounds, or at least seed rounds, come online, and that's going to really increase the odds for you as the investor to invest in some really big winners. And if you're the entrepreneur, maybe you're not looking at this from the investor perspective, but you're going to be able to get on and in front of a more sophisticated investor class that have more money to invest. So hopefully that all makes sense, and if it did, let me know in the comments if you have any questions. Thank you again for watching all the way to the end of this video. Check out all of my other videos talking about entrepreneurship, investing in startups, building startups. Please invest in me by giving this video a like and subscribing to the channel. And until next time, keep hustling.